What's up, everyone? Welcome back to Thoughtful Investing. Folks, some of the best businesses in the world are middlemen. Visa, MasterCard, even your realtor. They make money on every transaction without taking big risks or putting up their own cash. And that's exactly what Brown & Brown does in the insurance world. This company has outperformed the S&P 500 for decades, but in the last 12 months, it slipped 23% behind. So, is this a massive buying opportunity hiding in plain sight? We'll answer that question by breaking down how the business makes money, the acquisitions fueling its growth, and then dive straight into the numbers with a full valuation, complete with base, bear, and bull case scenarios to find out if the stock is truly undervalued or not. Let's get started. Brown & Brown's story started back in 1939 when Adrian Brown and his cousin Charles Covington opened a small insurance agency in Daytona Beach, Florida. What began as a tiny family business has grown into one of the largest insurance brokerages in the world. On the left, you see J. Hyatt Brown, who ran the company from 1993 to 2009 and now serves as chairman. And today, his son J. Powell Brown is CEO. Insiders like them still own about 15% of the company, and nearly 20% if you count employees too. With leadership that has real skin in the game, the focus stays on long-term growth, not Wall Street's short-term noise. The business is divided into three segments. First up, the retail segment, which accounts for about 58% of the revenue. This is where they sell everyday insurance, like your car, home, or even employee benefits for businesses. Think of it as your local insurance office, but backed by a huge national company. Next up is the national programs segment, which account for about 29% of the revenue. This is where they design special insurance just for certain groups, like dentists, lawyers, or even schools, and then share it nationwide through thousands of agents. And then finally, there is wholesale brokerage. This is the middleman that helps smaller insurance agents get hard-to-find coverage, like for race cars or big concerts. Typically, Brown & Brown targets the middle market, and that gives them a powerful edge. On one side, insurers would need massive sales teams to reach all those mid-sized clients directly, and that's not feasible. On the other side, middle market businesses don't have the time or resources to negotiate with hundreds of insurers either. So Brown & Brown steps in as the essential connector, linking buyers and suppliers in a way that's almost impossible to displace. Now let's talk about growth. Back in 2001, Brown & Brown was pulling in just under $500 million in revenue. By 2011, they cracked the $1 billion mark, thanks to big moves like Arrowhead and Beecher Carlson. Fast forward to 2018, revenue doubles again, crossing $2 billion with the Hayes Group deal. But here's the rocket fuel. From 2021 to 2024, major acquisitions like GRP, Orchid, Kentro, and Quintez launched revenue past $4.8 billion. That's nearly a 10x jump in 2 decades. In terms of revenue, right now the US is leading at 86%, the UK contributing 11%, and other markets adding 3%. But there is a lot more focus on international markets. They've expanded into powerhouse markets like Germany, France, and Italy, plus growth hubs like Singapore, Malaysia, and the UAE. Their plan is clear: drive organic revenue, fuel expansion through acquisitions, and move into regions with strong rule of law, stable economies, and booming insurance markets. Continuing the growth streak, in 2025, Brown & Brown pulled off its biggest deal ever, buying Accession for $9.8 billion. This purchase was financed with $4 billion equity raise and about $4 billion in new debt. Accession is the 9th largest U.S. insurance broker, with $15 billion in premiums, $1.7 billion in revenues, and over 5,500 employees. Their risk strategy segment is moving into Brown & Brown's retail segment, while 180 intermediaries is going to roll into a new specialty distribution division. This deal is one of the reasons why the stock has underperformed recently. Wall Street is nervous about whether they can integrate Accession successfully. Another concern is about the potentially softening insurance market, which we'll talk about shortly. Now, although this is a mega acquisition, I believe that Brown & Brown can execute on this deal given their long experience of acquiring companies and based on their decentralized sales and service model. Under this model, they centralize the heavy stuff: finance, tech, acquisitions, legal, so the back office runs clean and efficient. But out in the field, sales, service, and marketing stay local. That means reps can move fast, adapt to customers, and stay plugged into their communities. This model gives them efficiency at the top and agility on the ground. It's like having the scale of a giant with the speed of a startup. Before I go into the financials, I want to have a quick word on the insurance business cycle. Think of it like a seesaw. In the soft market phase, prices drop, companies compete, and getting coverage feels easy. But when too many claims roll in, say after a bunch of hurricanes or accidents, insurers tighten up. Suddenly, it's the hard market. Prices climb, coverage gets harder, and discounts disappear. Over time, profits bounce back, competition heats up again, and the cycle repeats itself. But here's the key. Companies like Brown & Brown keep growing no matter the cycle. Organic growth is higher in hard markets, while soft markets open the door to cheaper acquisition opportunities. Either way, the business continues to move forward. Let's dive into the financials. For growth companies like this one, I'm focused on four key things. Number one, growth. I want to see that consistent growth across the entire business cycle, not just a one-hit wonder. Number two, profitability. Growth is great, but if you're not making any money, we have a problem. Number three, shareholder friendliness. That means minimal dilution and fair equity-based compensation. Basically, take care of common shareholders like you and me. And finally, solvency. I want a rock-solid balance sheet, low debt, and very low chances of bankruptcy. So let's see how Brown & Brown stacks up. Revenue has tripled in the last decade, from about 1.6 billion in 2015 to almost 5 billion today. It's really a mix of steady organic growth in their brokerage business and a string of acquisitions, as we saw earlier. Operating income and net income climbed in lockstep, hitting 1.5 billion and 1 billion respectively. Although growth has slowed slightly in the second quarter of this year, with net income dropping by 10%, and that's really because of rising expenses from integrating new acquisitions and higher interest costs. Free cash flow has also compounded nicely, getting up to 1 billion in 2024. That's really powered by low capex needs and efficient operations. They don't need heavy investments like a factory or tech company, so much of their profit falls straight to cash. You can see the same thing in the net income to free cash flow conversion, where they convert more than 100% of their net income to free cash flow. The margins really tell the efficiency story, with operating margin near 30%, net margin at 20%, and free cash flow margin around 20%. The reason margins are so high is because, as I explained earlier, insurance brokers earn fees without taking underwriting risk. They're just middlemen, not the actual insurers. That means that they don't need to hold big reserves or cover claims. They just scale people and software. The return on invested capital is about 10% for the most part, and the return on equity is a little bit higher at about 15%. And this is because Brown & Brown uses leverage, as in debt, to scale and amplify profits. Moving on to shareholder friendliness, you can see that there has been very minimal dilution over the past 3 and 5 years, and essentially nothing over the last 10 years. This is because they do buybacks every year that offsets the stock-based compensation, and also any stocks issued in relation to acquisitions. This purple negative bar that you're seeing in the trailing 12 months reflects some of the stock that they have issued this year to fund some acquisitions. And that is an okay thing to do if the acquisition is at the right price and works out in the long term. Now, in terms of stock-based compensation, you can see that it's very reasonable, running at about 2% of the revenues. That compares very favorably with other mature growing companies like Microsoft, and much lower than companies like Meta or Google. Now, moving on to the solvency metric, the net debt to EBITDA is about 2.4. I like to see this number below 2.5, so I'm okay with that. The interest coverage is at a very respectable 10 times, which means that they are generating enough net income to pay their interest payments 10 times over. The current ratio, which is a ratio of the current assets to current liabilities, is also above 1. So overall, I think that this is a conservatively run company with a very low chance of bankruptcy. So ultimately, Brown & Brown runs a boring but brilliant model. Grow by acquisition, keep risks low, turn profits into cash, and use discipline to play offense when opportunity strikes. And now let's move on to valuation. I'll present a base case, a bear case, and a bull case. By the way, if you're enjoying this video, please hit like and subscribe to the channel so you don't miss out on more deep dives like this. Alright, back to the base case. In this scenario, I'm assuming steady growth, stable margins, and that the insurance cycle does not soften any further. I'm assuming that revenue rises in line with the 10-year average, which is about 12%. The operating margin comes to about 28%, and the FCF margin at 20%, which is a touch lower than where these values have been recently. I'm also assuming that the current enterprise value to EBIT, which is operating income, remains at 18.7. And then finally, I'm assuming a 10% discount rate. In this scenario, I'm getting a 2029 fair value of 156, which is a 10% year-on-year return from here. That is pretty much a market equivalent return and not something to get terribly excited about, but bear in mind that this is a quality company, and companies like this have the ability to surprise to the upside. Also, please note that nothing here is investment advice. This is just my own analysis and modeling. Please do your own due diligence before buying the stock. All right, moving on to the bear case. In this scenario, I'm assuming that the mergers and acquisition activity stumbles, margins compress because of wage inflation and competition, and that the insurance cycle softens further. In this case, I'm assuming a 10% year-on-year growth in revenue, which is much lower than their long-term average. I'm also assuming that the operating margin compresses to 24% and FCF margin to 18%. Given these metrics, I'm assuming Wall Street assigns a much lower EV to EBIT multiple of 14, and I'm using the same 10% discount rate. I'm getting a 2029 fair value to about $92, which is pretty much where the stock is at today, and that equates to a minus 1% year-on-year return for the next 5 years. So basically, I don't see much downside at this price point. And finally, the bull case. This is where I'm assuming that the acquisition engine keeps firing. Market rewards the defensive growth profile of this business with a higher EV to EBIT multiple of 20. Margins expand due to technology investments and scale, and that the insurance cycle hardens. Here I'm assuming a 16% year-on-year growth. This is a level that CoStar has actually achieved in the last 3 years, so this is not an impossible wall to climb. I'm assuming that the operating margins go up to 30% and the FCF margins go up to 24%. Again, these are numbers that are quite achievable. Assuming a 10% discount rate, this gives me a 2029 fair value of about 215. So basically a year-on-year return of 17%, which is more than a double in 5 years. This chart shows how the current price compares to the 3 scenarios, and you can see that in 2 out of those 3 cases, the future price is above at the current stock price. Now, depending on which case you believe in, this table shows you your expected return at different price points. So let's say you are a believer in the bull case and buy the stock at $78. You can expect, according to my model, a 23% year-on-year return. Similarly, if you are more of a base case person, if you buy the stock at $83, you can expect a 13% year-on-year return. Personally, I think this is a high-quality company. I'll be interested in starting a position at around $90. At that level, my downside is pretty much zero, and I can expect a return of about 11% or higher, depending on how the situation plays out. Anyways, this brings me to the end. If you got value from this breakdown, do me a favor, smash that like button, hit subscribe for more stock insights, and drop a comment below to let me know if you agree or disagree with anything I said. Thanks for watching, and I'll see you in the next one.